Welcome to this video. This video deals with time-varying costs of capital. To show how to deal with time-varying costs of capital, we consider back the example we have analyzed in the previous 3 videos. We had a 2-period project starting at 0 and generating 2 incomes at time 1 and time 2. I remember that the incomes were 375 in the first period and 225 in the second period. The capital invested at the beginning of the first period was 600, and the capital that remains invested at the beginning of the second period is 400. At time 2 the capital is 0. After liquidation the project is over and no capital is invested in the third period. Now let us suppose that the cost of capital, which we denote as R as usual, is time varying, is not constant, it's not time invariant. And suppose that it is 15% in the first period and 30% in the second period, which means that the market rate, the structure of market rates, is 15% for investment starting at time 0 and ending at time 1, and 30% for investments starting at time 1 and ending at time 2. So how should we cope with this situation? Now, remember that we have 4 equivalent ways to compute the project AIRR, the project's rate of return. One of these, let us take one of these, which we illustrated in the 3rd video. The project rate of return, AIRR, may be defined as the present value of all the incomes divided by the present value of all the capitals, and this is an instantaneous rate of return, multiplied by a conversion factor, which is 1 plus R. And this is the case when the cost of capital is constant. Well, if the cost of capital are time varying, the structure is the same. However, we only have to replace the conversion factor, and instead of the constant cost of capital, we place the first period cost of capital. So let us apply this formula to our project. Let us compute the discounted sum of incomes and divide by this discounted sum of capitals. And so we have the first income, which is 375. We divide it by the first discounting factor, which is 1 plus 15%. This is the present value of the first income. Now we have the second income. The second income is discounted by 2 periods, and in the 2 periods we have 2 different costs of capital. So 225 is discounted by dividing by the product of 1 plus the first cost of capital, 15%, and 1 plus the second cost of capital, which is 30%. And we have the present value of the income of the project's overall income. As for the capital, we have 600, which is invested at time 0, and we add 400 discounted back by 1 period. The first period cost of capital is 15%. So this is our rate of return in present terms. We want an annual rate of return. We just have to multiply by 1 plus the first period cost of capital, 15%. And we get the project's rate of return. The project rate of return is 57.8%. 57.8%. This is the project's overall rate of return. Project's overall rate of return. And now we have a problem, because we are able to compute the project's rate of return, but we have to compute the minimum attractive rate of return as well. That is, if we have time varying cost of capital, what is the benchmark rate that we use as a comparison for the project rate of return? Well, we may apply the same conceptual and formal schema that we have used for the project's rate of return. That is, if the investor invested the capitals in the market instead than investing in the project, the investor will earn 15% in the first period and 30% in the second period. So the first income would be 15% of 600. Let us denote it by R, and this is the return, the market return obtained by investing $600 at 15%. And in the second period, the investor would earn 30% on 400. So essentially, investing the same capital amounts that are invested in the project, the investor would earn a different profit, a different return. Well, what we simply have to do is to discount these profits, these returns, and divide them by the capital invested. And we have the project's overall cost of capital. We have the minimum attractive rate of return. Let us do it. And we MARR, minimum attractive rate of return, that is the project's overall cost of capital, and we divide the present value of the market returns by the present value of the capital, and we multiply by the conversion factor 1 plus R1. So we have that the first return is the 15% of 600. 15% of 600, which we divide by 1 period, 1 plus 15%, and we add the second market return, 30% multiplied by $400, and we discount by 2 periods. At 15% first period and at 30% second period. This is the total return in present terms. We divide it by the total capital invested, which is 600 plus 400 divided by 1 plus 15%, and we just have to multiply by 1 plus 15%. And we get the minimum attractive rate of return, the overall cost of capital. And it is 19.2%. 19.2%. Now, we may compare the project rate of return and the project's overall cost of capital to capture value creation or value destruction. In this case, we have 57.8%, which is greater than 19.2%. This is the rate of return on the project, and this is the overall cost of capital. The overall cost of capital, or the minimum attractive rate of return, MARR. So it is evident that the project creates value, because for each dollar of capital invested, investor earned 0.578, whereas if the same capitals were invested in the market, the investor would only earn 0.192 per unit of capital invested. And what about the net present value, which measures the economic value created by the project? Well, the net present value is simply the product of the investment scale, of the investment size, and the excess return rate. More precisely, the net present value maintains the same product structure that we have seen in the previous videos. We have the total capital invested and we multiply the investment scale by the difference between the project rate of return and the overall cost of capital, the minimum attractive rate of return. Then we discount back by 1 period, because we want a present value, a present value. So we discount back by the 1 period with the first period cost of capital. In our case, we have that the present value of the capital is 947.8. We have computed this several times. Then we have the 57.8% rate of return. We deduct 19.2%, which is our benchmark rate. We discount by 15% and we get the net present value. And the net present value in this case is 319.1. It is positive, which confirms that the project creates value. This is the investment scale. Investment scale 947.8. And the second factor is the economic efficiency. in present terms. Economic efficiency. The numerator of this ratio is the economic efficiency. It measures the economic efficiency in annual terms. If we divide it by 1 plus 15%, we get an economic efficiency as measured in present terms. In general, we have that the AIRR will be given by the present value of the incomes. So first income discounted by 1 period, second income discounted by 2 periods, 1 plus the first cost of capital times 1 plus the second cost of capital, and so on until the last income is generated, I of n, which is discounted by n periods with the n cost of capital. At the denominator of this ratio we have the present value of the capitals. So we will discount back the capital invested at the beginning of the second period by 1 period, and so on until the last capital, which is C of n minus 1, is discounted back by n minus 1 periods. 1 plus R of n minus 1. Okay. And the second step, we just have to multiply this by 1 plus the first period cost of capital. So let us move to the right. We just have to multiply to convert to an annual rate. And this is the project rate of return. As for the minimum attractive rate of return, the structure is the same, the formula is the same, but we have to replace the project's income, the project's profits, with the market returns. So if we want the MARR, let us call it a minimum attractive rate of return, or overall cost of capital, as you prefer, and we have the same ratio, but instead of the project incomes we have the market return. The first market return, if we invested C0 in the market, would be R of 1 times C of 0, and we discount back by 1 period. The second market return would be R of 2 times C1, and we discount by 2 periods with the 2 costs of capital, with the first 2 costs of capital, and so on until the last market return, which is R of n times C of n minus 1, and we discount back by n periods. So we have this product. Now while it's evidently boring to write all these products with a spreadsheet, this is very simple. It is very simple to make the computation. At the denominator, the denominator is the same. The capital invested in the project, which is also the capital that would be invested in the market. So we compute the last capital again by n minus 1 periods. And the second step is to multiply again by the conversion factor. So we just add the factor 1 plus R of 1, which multiplies the ratio, the instantaneous overall cost of capital. We can write all this in a more manageable way. We can write that the project rate of return is equal to present value of incomes divided by present value of capitals times 1 plus the first cost of capital, and the minimum attractive rate of return, the overall cost of capital, is given by the present value of the market return. We use the letter R to denote the market return. We divide this by the present value of capital and multiply by 1 plus R of 1. And we can compare the two rates, the project's rate of return and the benchmark rate, to get value creation, to capture value creation, and the net present value is equal to total capital invested times the excess rate of return, AIRR minus the overall cost of capital divided by 1 plus R of 1 to have the present value, and the project creates value if NPV is greater than 0. Otherwise the project destroys value.